A pleasant day to all. Last time, we have mentioned that cost of capital is one of the factors to consider in determining the capital structure of the business organization. This time, we will focus our discussion all about cost of capital because it is an integral part of investment decision as it is used to measure the worth of investment proposal provided by the business. Cost of capital is also called as cut-off rate, target rate, hurdle rate, and required rate of return. When the firms are using different sources of finance, the finance manager must take careful decision with regard to the cost of capital, because it is closely associated with the value of the firm and the earning capacity of the firm. Let's take a look at the other definitions of the cost of capital. Cost of capital is the rate of return that a firm must earn on its project investments to maintain its market value and attract funds. Cost of capital can best be described as the ability to cover both asset and liability expenditures while generating a profit. Cost of capital is the return, percent, expected by investors who provide capital for a business. Once this cost is paid for, the remaining money is profit. Since it generates a specific number that determines profitability, it's used to determine the hurdle rate. The cost of capital metric is used by companies internally to judge whether a capital project is worth the expenditure of resources, and by investors who use it to determine whether an investment is worth the risk compared to the return. The cost of capital depends on the mode of financing used. It refers to the cost of equity if the business is financed solely through equity, or to the cost of debt if it is financed solely through debt. Cost of capital has the following major assumptions. It is not a cost as such. It is a hurdle rate. Cost of capital is not a cost like other operating costs of the company. When we say hurdle rate, it is the minimum return that a business needs before it will launch a project or other form of investment. This is otherwise known as the target rate, the required rate of return, or the minimum acceptable rate of return. The company uses hurdle rate for them to have a concrete decision in making investment, such as launching a new project or buying a security. Before a company moves forward with an investment, the company should realize that the rate of return is equal or more than the identified hurdle rate. When the firm recognized returns below the hurdle, the investment is typically considered either too risky, or in some cases, unprofitable compared to other alternatives. It is a minimum rate of return. One of the assumptions of cost of capital is that it is the minimum rate of return. This means that company uses cost of capital to measure the expected rate of return for a particular investment. So, before the company decides to invest in a certain business activities, they should ensure that the computed cost of capital is not lower than the hurdle rate. The last assumption is, it consists of three important risks: the zero risk level, business risk, and financial risks. When we say zero risk level, it only means that the risks associated with the investment is usually low because in reality, there is no such thing as zero risk. Any investment may encounter uncertainties. Business risk refers to the uncertainties or unexpected events that are beyond the control of the firm, and, lastly, financial risk is the possibility of losing money on an investment or business venture. Moving forward, cost of capital is classified into four different categories: explicit and implicit cost, average and marginal cost, historical and future cost, and specific and combined cost. The cost of capital may be explicit or implicit cost on the basis of the computation of cost of capital. Explicit cost is the rate that the firm pays to procure financing. On the other hand, implicit cost is the rate of return associated with the best investment opportunity for the firm and its shareholders that will be foregone if the projects presently under consideration by the firm were accepted. In layman's term, explicit costs are normal business expenses that are recorded in a company's general ledger and clearly affect a company's profits. Expenses relating to advertising, supplies, utilities, inventory, and purchased equipment are examples of explicit costs. On the other hand, implicit cost is the opportunity cost. It is also known as implied cost. Meaning, implicit costs are not clearly defined, identified, or reported as expenses. An example of an implicit cost is the time spent on a certain business activity that could better be spent on a different business initiatives. Take note that an explicit cost is a define the particular amount that appears in the general ledger, whereas an implicit cost is not initially shown or reported as a separate cost. In obtaining the explicit cost, just simply add all the expenses incurred and all costs together, then subtract the principal amount. Another classification of cost of capital is the average and marginal cost. Average cost of capital is the weighted average cost of each component of capital employed by the company. It considers weighted average cost of all kinds of financing such as equity, debt, retained earnings, etc. The weighted average cost of capital represents its blended cost of capital across all sources. Each type of capital has its corresponding cost when the company obtained it. Thus, average cost of capital pertains to the summation of different percentage of the different capital. For example, company XYZ has the following costs of capital: cost of equity, 15%, and cost of debt, 20%. Then the average cost of capital would be 35%. Marginal cost is the weighted average cost of new finance raised by the company. It is the additional cost of capital when the company goes for further raising of finance. We all know that different types of capital, such as debt, equity, stock, etc., are used by the company. These types of capital in different amounts of course consists of different costs. If the company decides to raise additional funds and we tend to evaluate it, this is called the marginal cost of capital. Remember that marginal cost is the cost of capital that is minimal and may include a basic interest rate cost structure. Let's have a basic example of the marginal cost of capital. Let's say, the company ABC raises funds by issuing equity shares in the market amounting to 100,000 at an interest rate of 10% per annum, compounded annually. This is additional funds raised by the company. Then, the marginal cost of capital for raising new funds for the company will be 10%, and that is 10,000. Another classification is the historical and future cost. Historical cost is the cost which has already been incurred for financing a particular project. It is based on the actual cost incurred in the previous project. In simple words, historical cost represents cost incurred in the past in acquiring funds. In addition to that, historical cost is an accounting method being used by the firm to see the original price of the capital because these prices are well recorded in the company's book of account. This type of cost of capital is beneficial to the firm because they can easily ascertain what price was paid for the capital. Future cost, on the other hand, is the expected cost of financing in the proposed project. Expected cost is calculated on the basis of previous experience. These costs are based on forecasts. A good forecast of capital cost is essential for the financial managers for them to figure out the future financial situations of the company. Take note that forecasting of future costs is required for expense control, the projection of future income statements, appraisal of capital expenditures, the decision on new projects and on an expansion program and pricing. The last category is the specific and combined cost of capital. Specific costs refer to the cost of a specific source of capital such as equity shares, preference shares, debentures, retained earnings, etc. This classification of cost is necessary for the company can easily identify every specific source of capital. Composite cost of capital refers to the combined cost of various sources of finance. In other words, it is a weighted average cost of capital. It is also termed as overall costs of capital. Remember that in evaluating a capital expenditure proposal, the composite cost of capital should be as an acceptance or rejection criterion. When capital from more than one source is employed in the business, it is the composite cost which should be considered for decision-making and not the specific cost. But where capital from only one source is employed in the business, the specific cost of those sources of capital alone must be considered. Moving on, let us discuss the significance of cost of capital. Importance to capital budgeting decision. One of the bases of capital budgeting decisions is the cost of each capital source. Realistically, the value of the company's cash inflows should be higher than the value of the cash outflows. The firm can be able to obtain the firm value because of the calculation of the cost of capital. Apart from that, the cost of capital can also aid in making key company budget calls that use company financial sources as capital. Importance to structure decision. Capital structure of the firm composed of different types of long-term securities, and the firm should consider the cost of capital so the better decision pertaining to capital will be structured. If the organization found out that the cost of capital is suited to the available sources, then the firm can be able to make a solid structure decision. Importance to evolution of financial performance. Another importance of cost of capital is relatively connected to the evolution of financial performance. Cost of capital is one of the important factors which affects the capital budgeting, capital structure, and value of the firm. Thus, the financial manager can able to evaluate the financial performance of the company. Cost of capital is also important to other financial decisions such as market value of share, earning capacity of securities, etc. Hence, it plays a major part in the financial management. Another important topic that we need to discuss in the area of cost of capital is its computation. Remember that when we are talking about the computation of cost of capital, it consists of measurement of the specific cost and the measurement of overall cost of capital. The first part of the computation of cost of capital is focus on the measurement of the specific cost of capital. Like what we said on the earlier part of the video presentation, specific cost of capital consists of different capital source of finance. Thus, measurement of the specific cost of capital composed of cost of equity, cost of debt, cost of preferences shares and cost of retained earnings. Cost of equity capital is the rate at which investors discount the expected dividends of the firm to determine its share value. Cost of equity is the rate of return a company pays out to equity investors. A firm uses cost of equity to assess the relative attractiveness of investments, including both internal projects and external acquisition opportunities. Cost of debt. When we are talking about the cost of debt, always keep in mind that this is the rate a company pays on its debt, such as bonds and loans. It is also one of the important components of capital structure. There are two common ways of estimating the cost of debt. The first approach is to look at the current yield to maturity of a company's debt. The other approach by looking at the credit rating of the firm. Cost of preference share. The third measurement of the specific cost of capital is the cost of preference share. It is the annual preference share dividend by the net proceeds from the sale of preference share. In other words, cost of preference share is an amount paid by company as dividend to preference shareholder is known as cost of preference share capital. The last one is the cost of retained earnings. Cost of retained earnings is the same as the cost of an equivalent fully subscribed issue of additional shares, which is measured by the cost of equity capital. Take note that all capital comes with costs, and the cost of retained earnings must be taken into account when calculating the weighted average cost of capital, WACC. Retained earnings are included in the WACC equation as equity. As dividends, retained earnings are component of the return on capital to equity stakeholders. Thus, it will have a correspondingly weighted influence on the cost of equity. Next part of the computation of cost of capital is the measurement of its overall cost. It is also called as weighted average cost of capital and composite cost of capital. Weighted average cost of capital is the expected average future cost of funds over the long run found by weighting the cost of each specific type of capital by its proportion in the firm's capital structure. The computation of the overall cost of capital involves the following steps. A. Assigning weights to specific costs. B. Multiplying the cost of each of the sources by the appropriate weights. C. Dividing the total weighted cost by the total weights. In the nutshell, determining the cost of capital is very essential in valuation process of the company. It helps the organization to have a solid basis for different financial decision making such as investment decision, capital budgeting decision, and maximizing market value of the company. Cost of capital is one of the chunks of financial management that every financial manager should focus on because this plays the integral part of the company's financial decisions. That's all for this video presentation. Please comment down your major takeaways about this lesson. Thank you very much and God bless you all.